So over the last couple of weeks, we've had a number of conversations that have been quite common with respect to mismanagement of what assets are being placed inside of which particular account. And more often than not, it is folks approaching or in retirement where collectively their assets all do one thing. They provide income and resources for their retirement, nothing more. Much different than in the accumulation phase where you are actually, you might have money delegated for emergency savings or for a new purchase or what have you. But in retirement, or once you're financially independent, it really does one thing, and it's going to provide you your income for the rest of your life. And because of that, it needs to be invested according to the taxation in each individual account. Too often we find high interest, high yield securities being carried in non-registered savings, whether it would be low yielding GICs, annuities, bonds, everything that pays out interest, which is the highest tax rate for Canadians in non-registered accounts. Meanwhile, all of the tax-deferred, return of capital, equities, private equity, etc., all sitting in registered accounts. Well, those registered accounts shield from annual tax. So what has to happen is we need to have a reversal. The challenge on why clients cannot do this and why they sprinkle a little bit of everything into each account is because they have a different perception of what each account is actually trying to accomplish. But that is not the case unless it is absolutely clearly delegated for a specific purpose. Then it should be invested as one unit. And so that way, all of your tax deferral mechanisms should be in your non-registered account, and all of your forced taxation from your yielding and dividend security should come from your RSP and registered accounts, and also your TFSA, obviously. Why that's important is because more often than not, folks start to realize, I'm going to have significant impact on the tax on my RSP. So what they are eligible to do in that circumstance is they're able to start drawing from their RRSP to actually start to sprinkle between spouses and match, pulling out of that RRSP at a more opportune time rather than just paying 50 cents on every dollar upon death to the estate. And the reason why they don't want to do that is because if they have a significant amount of capital in their non-registered savings that is paying high yield and high dividend and forcing taxation, by pulling money out of their RSP or their RIF, they're just going to get layered on with more and more tax. So by properly managing which securities are held in which accounts, you are able to create a much more tax efficient stream of income. But the important part is you have to manage it as a collective in order to achieve that efficiency.